All right, we're live. Welcome. Thank you for tuning in. This week's episode of Real Estate in Real Time, we're going to be talking about interest rates. Some very interesting information came out over the weekend, yesterday, talking about the Fed rate and what's going to be happening in 2021 with respect to interest rates. And it's the first that we've heard kind of consistently about rising interest rates and what that does, what that will do to purchasing power, et cetera, et cetera. And I wanted to address that. So let me hop right in. If you have any questions at any time, feel free to drop a comment down below. I should be able to see them as we're going through this. So make sure you tune in with any questions. Give it just a second for some folks to hop on here. Welcome. Comment on over just friends mode. How do I change the settings? No? Okay. Anyways, all right, let's hop in here. Let's hop into the report. So here's the newest report from Stephen Thomas's reports on housing. We get these every 2 weeks, and I'm happy to send them out. Again, just drop a comment down in the comment section. I'll be happy to email it or message it to you right after this is over. So let's talk about interest rates, right? You've heard that they are super low. You've heard that they are maybe even historically low. What does that really mean? So he goes in and says today's mortgage rates. He actually kind of does a pun or a play on Black Friday, Cyber Monday, kind of all the holiday seasons, and says today's mortgage rates are at record lows and they offer the very best deal of the year. That will be changing soon. He says long-term debt or 30-year fixed mortgage rates are tied closer to long-term bonds versus the direct correlation to the Fed rate. It says prior to this year, the 10-year Treasury long-term bond, has never dipped below 1%. It's actually at 0.896 today. And he said prior to this year, mortgage rates have also never been below 3%, and they're at 2.7 as of yesterday when this report dropped. Bad economic news drives the 10-year down, and good economic news pushes the rate higher. COVID-19 and the economic recession due to the forced shutdown of the economy drove the 10-year below 1% for the first time ever. And this is kind of the meat of it here. It says the United States economy has now been on the mend. Retail sales have rebounded. New home sales and residential resales have rebounded. Consumers are consuming again. Manufacturing has returned. And there's light at the end of the tunnel. The coronavirus vaccine from Pfizer has been approved by the FDA, and distribution to all states started over the weekend. And I believe the first inoculation started today, I believe is what I saw. Second vaccine from Moderna is scheduled to be approved by the end of the week as well. By mid-2021, the bulk of the population will be inoculated from the virus with the vaccine. The economy will undoubtedly improve. With all the good news, the 10-year has improved from 0.645 in September to 0.896 today, so it's already increasing. In 2021, over the coming months, there will be more good news to follow. Congressional relief package should be passed pretty soon here. More positive vaccine news, more positive job reports as businesses start to open more and more again with the vaccinations and us coming out of the winter surge here. And positive economic reports. It will not be long before the 10-year pops above 1%. As a result, expect mortgage rates to increase from today's exceptional 2.7 to 3.5% by the end of 2021. Now, 3.5% is a great rate. Historically, it's still, the 2.75, 3.5 was tremendous. In 2018, we were talking about 4.95%. Crazy. 3.5 is still a great rate. It's not 2.7 though. So for a $750,000 mortgage, today's 2.7% payment of $30.42 per month would rise to $33.68 a month at 3.5%. The difference of $326 per month for the same amount of money that you're borrowing, or an extra $3,912. Total of $3,912 over the year. 3.5%. Even he talks about 3.5% is still a great rate. It's a significant impact, however, on your payment. This chart is pretty interesting. So what I did is circled here the current rates and then what the prediction is for the end of 2021 calendar. So a $500,000 loan, 20% down at 620 or so. You're looking at 2028 today, and the same price, same loan amount. Next year 2245. You're looking at $17 a month at 750, 3042 to 3368 that we talked about. And at $1 million loans around the jumbos here, 4,055 to 4,490. You can see all the numbers in between if they don't go quite that high. But I think the bottom line here is they are going to rise. They're going to start rising as the economy does better. The interest rates are going to have to rise. They've been suppressed so long and so low because of the economic downturn that as we come out of this, they're going to start to have to rise because again, it's a sign of a good economy. Let's go on to the next page here. Oops, I'm sorry. It says a buyer with a 20% down. This is interesting. This is kind of the flip side as far as affordability versus direct price here. A buyer with a 20% down payment that desires a monthly principal and interest or P&I payment of $3,000 is able to purchase today a $925,000 home. Okay. With the mortgage rates projected to rise to 3.5% by the end of next year, that $3,000 desired payment will yield just an $835,000 home. That's a jaw-dropping $90,000 less in purchasing power. Significant difference in what they're looking for. I did some calculations. We're talking about where did I write it down? 9.1% decrease in affordability, right? So if you can purchase a house today for $750 with 20% down, if the rates go up to 3.5%, that same 20% down payment to get the same monthly P&I payment, you're looking at a purchase price then of $681,750. So you're losing $70-something thousand in purchasing price. Now, no one is still predicting prices to drop. So we're still going to be predicted to be in an increasing market. So if prices still continue to rise and the rates are going up at the same time, your purchasing power is dwindling faster and faster. So that's very important to understand and very important to realize if you are thinking about making a move. Today's 2.7% rate is a Black Friday, Cyber Monday type of deal. It's a record low that is motivating buyers to storm the housing market. As the U.S. economy improves over the course of the year, mortgage rates will climb. With today's powerful housing demand in Orange County, the strongest December demand since 2011, combined with today's record low active inventory level, the lowest reading since tracking began in 2004, home values will appreciate in 2021. With rising rates and rising home values, the time for buyers to act is now lock in the rate. So again, just talking about what's going to happen next year. Again, with the demand where it's at right now, I'm going to talk about that on the next slide here. Inventory being as low as it is, demand as high as it is, trickling up interest rates, less than 1% up total, shouldn't really have much of an effect on purchase price. However, it might tamper some demand. And they're all tied together, which is kind of what I wanted to mention too. If you are on the fence about selling and want to take advantage of the tremendous benefit you have as a seller right now, I mean, it's possible that this will tamper the market. There will be initial shock when the rate hits 3% again, although it's still a tremendously great interest rate. If they start to trickle up to 3.25%, 3.5%, or more, that will send some more shockwaves into buyers that are now expecting these under 3% or sub 3% rates. If they go up to 3.5%, even 3.25% at that matter, so we will lose some buyers out of the buyer pool. If too many of them get squirrely or get a little bit hesitant, that will affect demand. And if that happens, that's when you start to see prices flatline or drop a little bit. So as a seller, I would be paying a pretty keen look at this. We can provide updates on a weekly or bi-weekly basis. We have an excellent tool to track home values that we can send your way. We have a lot of ways to help you understand the changing market. This year has been very unusual, as we all know. Real estate, thankfully, has been as busy and booming as it has been. But there's a lot of uncertainty, especially at the turn of the year. Active listing inventory year over year for Orange County as a whole. The green line is what we're tracking here. So we are with the exception of the first month of the year, which is pre-COVID, we have not even eclipsed any of the numbers from the previous 3 years. We are down to just over 3,000 listings in the entire county of Orange. This time last year, 2019, we were at about 4,500. So is that 30% down on inventory. Talking about demand. If you followed these videos in the past, this is just an insane chart, tracking demand and then what happened with the initial shutdown, and then like a cannon, real estate came back like you would not believe. Here, demand is dwindling, as it always does this time of the year. He does talk about, and you can see here that demand is not succeeding too quickly at the end here. So buyers are still out there. There are lots of showings going on. There are homes being sold very, very quickly. And again, when you pair this low of inventory, which is again lower than any of the previous 3 years, and then you combine that with demand that's 20 or 30% higher than the previous years, and 2.7% interest rates, that's where you get this crazy real estate market. It's insane. It really is. I usually end these with a quick look at a couple of our close cities. Feel free to hop in and drop a comment if you want me to address any specific cities here. I can do that in real time. So let me do, I'm sorry, I had pulled something up real quick. Okay, so Anaheim, current actives, 95 homes for sale in all of Anaheim as of yesterday. Demand over the past 30 days, 124 homes went into escrow. So more demand than there is inventory, which means you're in a booming seller's market, right? And inventory can't keep up. That's where you get this wild, crazy ride that we're on. Market time, if you look at the next 4 or 3 lines here, market time today, 23 days on the market, 22 a couple weeks ago, 26 a month ago, pretty stable overall. Last year, so December of 1947, so homes are selling twice as fast as they are compared to last year. Buena Park, current actives 27, demand 46 homes went in escrow. So again, we're looking at almost double the current inventory. Picking up a little bit in Buena Park, 18 days on the market today, 21 2 weeks ago, 25 4 weeks ago, and actually last year was pretty hot in Buena Park, 28 days on the market. So a bit faster still, about 30% faster, but not quite as drastic as Anaheim that we just took a look at. Cypress, 17 currently on the market. This is just crazy. Cypress, as you know, is our bread and butter. It's where we live. It's where we've worked the longest and where we focus a lot of our efforts. A normal market, going back, years ago, you'd be looking at 90 houses for sale, 100 houses for sale at any given point. Condos, townhomes, single families, new construction, anything. Then it inventory dipped quite a bit several years back. We'd have 30, 40, 50. We dipped to 27, 28 here and there, which was very low. 17 is unheard of. It's 17 homes in the entire city. It's just nothing on the market in Cypress. 34 homes went into market into escrow, the last 30 days. So exactly double actually. And the market's just gotten hotter. 15 days on the market now to get a home sold, 24 days 2 weeks ago, actually 16 a month ago, so not much different than a month ago, but 40 last December. So homes are selling almost 3 times faster than they were this time last year. Just wild. Los Alamitos and Rossmore, they're smaller cities and unincorporated areas, if we want to be technical on Rossmore, but not as much data means the numbers can be skewed a bit differently. But Los Al, 6 homes on the market today, 14 went into escrow in the last 30 days. So again, a little more than double. Los Al's picking up a little bit. That could be a factor of not much inventory, but 13 days on the market right now. 43 2 weeks ago. There was some glitch in the market there. And again, like I mentioned, with cities as small as Los Alamitos and areas like Rossmore, the numbers might not mean quite as much. Cypress is 3 or 4 times bigger than Los Al, and then of course Anaheim is just a gargantuan. Sorry, my printer just started making noise for no reason. It just freaked me out. So let's go to Rossmore here. 10 homes currently on the market. 15 went into escrow, so not quite as hot as Los Al especially, and then Cypress like we talked about. 20 days on the market currently. 40 2 weeks ago, 30 3 weeks ago, 4 weeks ago, and 60 this time last year. And again, remember, Rossmore, average purchase price, average list price here is 1.6. The market is very different. Above about 1.25 is kind of where that that changes things quite a bit. I can actually pull that up and show you. Where is it in this thing? Talking about luxury pricing. I think I'm going too fast. Come on now. Come on now. Luxury detached. So here you can take a look. Market time, right? So 1.5 to 2 million is 49 days across Orange County. Under 1.25 to a million is 30, and quicker as you go down. So again, Rossmore is a bit different. It's a small area. It's also a more expensive area, so those numbers are a bit different. So guys, I hope this was helpful. If you have any questions, please drop a comment in the comment section down below. Let me check real quick and make sure I'm not missing any requests. But yeah, very interesting. And I hope you guys keep an eye on this. We do post our Mortgage Watch updates here and there. We can do it more frequently if you'd like. We can email them directly to you. I want you to know what's going on in the market. I want you to be informed when you go to make a decision. If you're thinking about something, if you're on the fence, not sure what the next best steps are, we just fielded a phone call not 20 minutes before this started about someone getting ready for retirement, kind of what they want to do, and we're talking about timing. This was on the phone just a few minutes ago. 2 or 3 years in advance, and they are smart enough to make that initial phone call to kind of get the ball rolling and get some good advice with respect to where the market is currently, what might be going on down the road. So, because we're here to be a resource to you. You know me long enough. We're not here to pressure you one way or another. We want to just make sure that you make the best informed decision for your family, whether you're buying, whether you're selling. Give us a chance to have a conversation. We'd love to help. And again, if you want any access to any of the tools that I have been talking about, shoot me a message, send me a text. You know how to get a hold of me. Our website's on the bottom here. Take a look there. All property search up to date. It's an excellent redesigned site as of this year, and going to be revamped again in January of 2021. So take a peek. Thanks again so much. Have a great day, and I'll see you next week.